Alrighty, good morning, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Schwab, and welcome to a new week in the markets. It's sure to have a lot of drama. That seems to be one of the things that has been consistent in the markets so far this year. Today, we're going to talk about a couple of things. One, we're going to look at conditional orders, and we're going to place an example trade of a conditional order where we're seeing a potential example trade setup, but maybe it's not quite there yet. So we're going to use a conditional order of a way of not missing an opportunity, one, but also avoiding getting into something that turns out not to be an opportunity. And both are wins in my book. The other thing we're going to spend a fair amount of time on today is trade management, because it's important to acknowledge both when you have a winner, a trade that is in a position where we have an unrealized gain. And two, it's important to recognize when we have a trade that didn't go our way and that needs a little trade management. So that's what's on the menu for today. If you are not following me on X, consider this your invitation. My handle is Barb Armstrong CS. We also have Cameron May with us in the chat. He is a fellow coach with decades of experience, and you'll want to follow Cameron as well, Cameron May CS. Just know that we will look at options today. Options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to practice and learn and make sure you understand what you're doing with respect to placing orders on the platform and with respect to your trading plans before you consider trading something in your live account. Know that past performance is not a guarantee of how a stock will react in the future. And there are some nuances and differences between Paper Money and a live account, and we'll discuss those as appropriate. We started the year with $25,000. Our max risk per trade is $5,000 if we were doing a stock purchase, and our max risk is $500 per trade. We focus on the short to intermediate term time frame. So let's go out to the Thinkorswim platform. And I'm not going to spend a lot of time on doing a market overview. Kevin Horner does a brilliant job of that at the market open. But what we're seeing on the S&P 500 is kind of a bit of consolidation, although the market did hit a new all-time high back on February 19th, but we're seeing a little bit of a pullback within a longer term uptrend. When we come and we look at the NASDAQ, we're seeing kind of a similar thing, another index that was up strongly over the last year and is consolidating and currently, sitting closer to a support level. When we look at volatility, it's at the higher end of the range. I drew this 20 line on the map, and we're sitting just above that 20 mark right now, which is kind of at the higher end of where it has spent most of the last year. If we come in and we look at sectors, and this is a public watch list, so here's sector indices, we can see that there are a couple of sectors hitting a new all-time high today. And so if we just look at, say, the last 4 weeks, and we look at consumer staples, that is hitting a new all-time high today. And, an easy way to check on that is say, hey, go out as far back as you can. And we can see that this month is the highest month this index has ever had. When we look at financials, we've got the same thing happening, don't we? It too hitting a new all-time high. So if you wanted to be bullish, these might be sectors where you might want to, have a peak, so to speak. And then we've got real estate, which has been strong in the last month, and healthcare, which is sporting a bit of an inverted head and shoulders pattern. Support and resistance are a range. They aren't a finite number, but it appears to be, breaking to the upside. And then over the last 3 months, we still have communications coming in pretty strong, don't we? But it's come down back to this 100-day moving average. That's the black line, and appears to be bouncing. Okay, so that's kind of what's going on as a quick overview, and that has, you know, we want to look at that and consider that as we look at potentially investing some of our money in short-term trades, right? Right. Okay. So I wanted to do a little trade management. So let's go and have a quick look. And I just want to have a quick look at the chat. You know, it's so awesome. We've got almost 250 people here live, and more streaming in by the moment. You know, but it's so awesome to see the community that is here and that gathers sometimes 15 or 20 minutes before this webcast even starts. So hello to Priya and John and Alfred and Wiley and Kevin and Austin and Lawrence and Ray and Riceburg and the rest of the gang. I saw someone mention that they are heading for Scottsdale this weekend. Kevin Horner will be there. So, and make sure, along with Ben Watson and the rest of the in-person team. So make sure that, you know, if you have the opportunity to get up and meet these guys, that you take it. They're really awesome human beings and great coaches. Okay. So we have 4 stocks in our iron condor category. And the one that is giving us the biggest issue right now is Microsoft. Micron and Dollar Tree are kind of going along and doing their thing. But Microsoft, we were legging into this one and we had just put the short put vertical leg on. And this is not going according to plan. And so we saw it kind of bounce on Friday, and we have this candle with a very long tail, but it's pulling back again today, and our short strike is here at the 405 level, and it's currently trading at 394, so it's below both our strikes. Now we have 3 weeks prior to expiration, so in 3 weeks an awful lot can happen. It seems to have found a support level here, but it's pulling back again. And so, you know, what do you do when you live in a shoe and people keep stepping on you? Well, sometimes you just have to say, you know what, I want to, you know, get out of this neighborhood while I can. And one of the things that I expected when I first started trading this short put vertical strategy is that if it had gone through both strikes, which this had, that would automatically mean I was at a max loss. But if we come and we look at this trade, we're down $152, you know, but we could be down 300, you know, we could be down $350. And so I would say this is a flesh wound and we don't like to take a loss. But if in fact this is establishing a new bottom because it's broken below this support level, maybe we just want to admit that this one did not go according to plan and take a small loss rather than taking a bigger loss. Okay, and that's kind of the logic behind the thinking on this. Okay, that we'd rather take a small loss than a much bigger loss. Okay, and so we are going to come in to Microsoft, and I've got these organized alphabetically. So we're just going to come in. The intention was that we buy it back for 29 cents. Well, sometimes things just don't go according to plan. So we're going to cancel and replace that and say, okay, you want 308 for it. And even though we're both through both strikes, because we still have, you know, almost 3 weeks left to go, we're quite a ways from max loss. So we are going to come in to this iron, it was in the iron condor category, say we, you know, we would like to buy this back and close it out. Okay. Now it's saying 3.8, 3.10. Okay. So I'll make sure that this gets closed out. So there's the first one. Now, on the short put vertical front, we have a trade on Triple M. And we talked about this on Friday, and we talked about closing it out on Friday because it was close to our 80%. Okay, there goes our Microsoft trade. So we're now out of that one. And let's go and look at Triple M. So Triple M, we're up 70%, and our goal was 80. But you know, today we have this candle pattern, you know, which indicates that this uptrend may be drawing to a close. It could be a temporary close. Of course, it could continue to go up tomorrow, but maybe we're in a position where we just want to cue Steve Miller and take the money and run. And so we are going to cue up the music, and we are going to come back into our working orders, and we're going to come down to Triple M. And we are, you know, we had the intention was to buy it back when it was worth 24 cents. But we, you know, this is an unrealized gain. It's currently trading at 33 cents, 33 and a half. So if we say, yeah, we want to cancel and replace this order, and you know what, we'll pay an extra 9 cents in order to turn this unrealized gain into a realized gain. Okay. So Susie Q and Jim are saying, yeah, take the money. Yeah. And Paul said on the previous trade, better a small loss than a max loss. Yeah. You know, I agree. But we position size for max loss just in case, even though it isn't our intention to take a max loss. So this is in our short put vertical group. Put that in there. Okay, so we're out of that trade. And we actually did hit our target on a trade today. On Friday. And that was Starbucks, because Starbucks was on my list of trades to look at. So, you know, our short put vertical, these were our strikes. They were at 110 and 108. It was expiring this Friday. And, you know, just to walk through how to calculate a trade that has hit a target or come close to a target, we could do the same, go through the same exercise on Triple M. And so kind of the idea here, let's walk through this one together, and then your homework, should you choose to accept it, you know, is to kind of, if you had placed that trade in your paper money account and exited on the previous trade, is to kind of walk through that thought process. So, you know, we were paid 42 cents a share, or $42 a contract. We did 3 contracts, and we paid 8 cents to close the trade out. So we were ahead by $34 a contract times 3 contracts. So we made a whopping $102 in total, less transaction fees on this account. But you know what? We call that a base hit. And we knew when we placed the trade that that was what we were aiming for. And in this example, we got what we were aiming for. And if we look at this and we say, well, how much were we risking? Well, we were risking $2, or the difference between the strikes, you know, minus the 42 cents. So we were risking a $1.58 per share, or $158 a contract. We ended up netting $34 a contract once we, you know, bought this back to take our risk off the table. And so our net return on that was 21.5%. And with a short put vertical, something in this, you know, 18 to 30% range is, you know, not uncommon. Okay. Okay, so Leon is asking, so what went wrong on Microsoft for a lesson learned? And I really like that question. Okay, so let me just go in and shake my Etch-a-Sketch, if you will, and get rid of this drawing tool. So that's how we calculate return on risk. So let's come back to Microsoft. Okay, and I didn't put, so if we come to the monitor tab and we change this to Microsoft, we placed this short vertical on the 21st. So we had another trade, another short vertical where, it had done exactly what we were expecting, and we had our 80% gain and a nice return. Then we did another one where we were planning on legging into an iron condor. We put that one on the 21st, and our strikes were at 405 and 400. So let's go back to the 21st. Okay, 19th, 20th. Okay, that's interesting. So this candle may not have looked like this when we put this trade on, because I would be surprised that we would have chosen to do this with such a big fat red candle. But when we look at it, this had been trading in a range. And sometimes you look at it in hindsight and you go like, why didn't I see that? And, we made the mistake in placing the trade in the first place, but it had come down kind of into this range of support, had hung out here for several days. And these candles that have a red line around them, even though it was down on the previous day, it opened lower and closed higher, opened lower, closed higher. And then here on the green outline days, it opened lower and closed above the previous day. So we had, all these kind of bullish candles at a support level. It had broken above this line, and we were looking to add this. And then if it continued to kind of move to the upside, we would have then added a short call vertical. And instead it came down and it broke below. Yeah, AP 514 is saying it was green when we placed the trade. So it looked like it was going to continue to the upside. Yeah. And so sometimes, in spite of your best technical analysis, there can be news that comes out, or, whatever happens. And as a trader, you have to plan for trades that are not going to be successful. That's why position sizing is so important. And we also have to recognize when we've made a mistake. When my kids were really young, my son made a mistake when he was in kindergarten, and it became the family mantra, like, when you mess up, fess up, and come up with a plan. And so on this one, as it turned out, in spite of our best efforts, we messed up. The trade didn't go according to plan. So today we fessed up and we came up with a plan to exit the trade. And actually we kind of fessed up on Friday and said we would watch and just see what happened. And so that's kind of that was kind of the plan. I'm just looking at the chat again. Somebody saying, I feel like 3M could still go higher. And you could be absolutely right. And sometimes though, one of my favorite coaches of all time, who is no longer with us, used to say, you don't trade what you think is going to happen. We trade what we see. And sometimes that can be, frustrating, because we see one thing and then it changes. And it's a little frustrating. Okay, so that was Starbucks. That was Triple M. Okay, I've got my little clock here. I just want to watch the time. Now, we had a trade on Amazon. And here's when we placed the trade. So here's another, this is trades gone wrong day. So, here's another, uptrending stock. We were, and this is one, that we may have gotten caught up in the tariff downdraft, the concern over tariffs, because Amazon does have a lot of products that they are selling. And anyway, we placed this trade on a technical bounce, and then it started to pull back. And now this expires March 7th, which is this Friday, and we're through both strikes. And one of the things that is different between paper money and a live account is that in paper money, short strikes will never be exercised early. And we have sold this 225 put which is saying that we're willing to buy the stock at $225 a share. So that's a $22,000 position. And we did a couple of contracts, I'm sure. Oh, even if we just did one, we did one contract, that's a $22,000 position. And so we are close to our max loss on this. And so you might say, well, hey, this could bounce, miracles can happen. And yes, they can. And we've seen this stock sometimes move a lot in 3 or 4 days. But if this weren't in a live account, you could wake up tomorrow and it could be assigned to you. And the closer you get to expiration, that, you know, the probability might be increasing. And the other thing that we don't want to have happen is it expire in between the 225 and the 220 strike. So we're going to, you know, this turned out to be kind of a mess up. We're going to fess up. And even though we're close to max loss, we are going to exit this position to avoid the potential risk of being assigned. Okay. And so we're going to come here. Again, cancel. We're getting a lot of practice at our cancel and replaces. We had anticipated buying that back for, 25 cents. That didn't quite work out. So 485, confirm and send. And that's in our short vertical group. And then I'm not going to take the time to go through it in class. I'll close this out after. But we had a similar situation with Google. And what we saw on Friday, we discussed this, is that we had this bullish pattern happening with this Harami. But today it's starting to pull back. And it's just pulling back a little. It could end up by the end of the day, but it has a long way to go to get us out of trouble. And so we're going to close that one out as well. Okay, so let's come and look at something that is a little more bullish. Now, in the trading after hours, yeah, so Valerie is saying, if you are assigned, so let's say you woke up this morning and you had been assigned, and it's kind of a random process, that you might be assigned. So if you were assigned, then you would exercise your right to buy to take this put, that your long put, you'd exercise your right to then sell the stock at 180 and you'd have your max gain, your max loss rather. Yeah. So somebody's asking what a Harami pattern is, and I will repost the chart. I have a kind of a summary chart of candle patterns. And I will also post, we talked about candlesticks and getting started with technical analysis last Tuesday. But if you have the body of one candle totally inside the body of the candle of the day before, that is considered to be a bullish a candlestick configuration pattern at a support level. Now, they don't always follow through. Like here we had this, and this is when we placed this trade, when we had this Harami pattern happening on the chart, and then this one didn't follow through. It kind of went sideways and teased us for a few days and then broke to the downside. Okay. Yes, this could be considered a morning star pattern if this were a white candle, which it could be by the end of the day. Okay. But as of this moment, it's down just like 28 cents, on a $170 stock. So we'll see. Okay. So let's go and look at Philip Morris. Now, when we look at Philip Morris, this is a stock that seems to be doing well. I don't know if there's a lot of anxiety out there in the world, might the smokers amongst us smoke more? When we look at Altria, which is in the same space, this stock has done pretty well of late also. And we've talked about this one in our, after the close, where we're building a portfolio that classes Thursdays, and you're welcome to join us for that one as well. But, so here's something else in the neighborhood. This is a staple. if we come and look here, and remember, staples are hitting, an all-time high today. And then when we come and we look at Philip Morris, do you see what I see? Well, I see a stock that gapped up on earnings. The last earnings was $1.91 a share, and it had a pretty dramatic move to the upside. This earnings was $6.57 a share, and they were expecting, the market analysts were expecting it to be $1.51. And so that's a pretty significant beat on earnings for starters, right? And then if we come and we look at the chart from a technical perspective, some might say, well, I'm seeing a series of, what do you guys see? Well, that was a gap. Looks like a bull flag, right? And with a bull flag, what are we looking for? We're looking for a close above the high of the low day. And do we have that? We do. If, just let me erase this. So if we look at Friday, we didn't have it on Friday because, we didn't close above the high of this low day, but we certainly have it today. Now, this is a live candle and it can change, but could we look at it and see if the options are such that it might meet our trading criteria to either buy a call or to do a long call vertical? Now, if we bought a call, what might we be looking at? So just let me close this out. So if we bought a call, we might come back here and say, and where you kind of put your target. So this was an increase of how much? Of about $10, $10.72. So you might start at this bottom here and say, well, if I went up $10.72, so I'm going to duplicate that, and then I'm going to bring it over here. My target might be somewhere around that 165 mark. So if I come to the trade tab and we come out to April, first of all, does this trade more than 1 million shares a day? Yes. Do we have at least 20 times the number of contracts we're thinking of trading? Yes. If we look at the money strike, is it in our snack bracket? Is it under $5? Yes, it's $3.30 to $3.50. And then when I look at this also, is the bid-ask spread tight enough to meet our example trading plan requirements? Well, it's a 20-cent difference on a $3.30. So is it under 10%? Yeah, it's 20 cents. So that meets our criteria as well. Okay. So could we buy this call and then put a target of, say, maybe make it 164.50? So target 164.50, and it's currently trading at 157. So, or we could, so if we call this 164.50, then if we say, hey, if it loses half its value, we'd like to exit. And so should we do 2 contracts? No, because what if it gapped down and we lost it all? Because there is the potential to lose it all. So we're trying to be conservative. And so we're looking to buy custom with an OCO bracket. So we're going to buy it at the current price. In this one, we're not using a conditional order. And we're going to make this a market order because we don't know exactly what this is going to be worth. We just know, okay, sorry guys, I have to go in and change something real quick. because it's not giving me access to what I need here. Okay, here we go. Now I can bring this up. Okay. Let's just bring this up again. I'm going to hit my little sprocket. And we want to sell this when it goes at or above 164.50. Now, if it gets up to 164 or 163.89 and we get, you know, a sign that this, you know, this may be turning around and maybe about to set up another bull flag, or, you know, this trend may be reversing, can we go ahead and close this out? Of course. You know, we do that all the time, right? Right. But that's our goal, is for this to hit 164.50. And if it loses about half its value or gets to the point where it's worth about 175, so about half, we'd like to exit. Okay, so we're doing one contract. We're looking to buy a call because we're bullish, right? Right. We're giving ourselves lots of time. So April 17th. We want to exit when Philip Morris goes at or above 164.50, or if this option loses half its value, we'd like to exit the position. It's saying here that our max profit is infinite, our max loss is 350, but you know, we have a target on this. You know, so that will in essence cap our potential gains, but we know that and we're okay with that. We're going to put this in our long call group, and we're going to note that this is a target based on a bull flag. Okay. Send. Okay, just let me look at the chat for a sec here. No sound. If you, well, hopefully you heard that. Okay, so Jerry is saying normally you don't recommend placing stops on an option trade due to the opening day volatility. So the volatility when the market first opens, and you are correct with a long call vertical. So if we were doing a long call vertical on this, say we looked out to 25 days here, we've got about 100 and some contracts, a 20-cent bid-ask spread. So if we did a long call vertical on this, we would put in a target, and we could do a long call vertical and just, so let's do that and we can compare them. So with the long call vertical, we put in a target, but not an exit. And so if we were bullish on this, we could say, you know, our expectation is that by the end of March, this will be above 160. So our target would be 50%, a 50% gain. And some traders like to put in a target and some don't. But we don't put in a stop. And why is that? The reason is because we don't want to risk getting whipped out for a loss, maybe perhaps way greater than 50%, and then have the volatility settle down and have us not, you know, where we wouldn't have been stopped out at all. And so we do that on verticals because we're willing to, you know, take the win if we get it because of volatility, but we don't want to take the loss. And so that's why we do it that way. And you know, I've seen that in live examples. And so I'm trying to help you guys create trading plans that might serve you well, or approaches to trading, if and when you ever decide to trade something in your live account. Now, this is just an example trade. It's not a recommendation by any means, but it might be interesting to look at and compare this long call vertical to, you know, the long call with the flag target. And so we're just going to do one contract. So how much are we risking? $273. How much could we lose? All of it. Okay. But, you know, if we were just doing this and not this and the long call, we might have done two contracts. We're going to put in a target to exit if it gets up to 409. Now, if in a couple of days, like if we meet on Wednesday for our trading price pattern class and we see that we're up 25 or 30% in a couple of days, could we just say, hey, that's a nice return in 2 or 3 trading days? Let's take the money and run. That's absolutely valid. There's no saying that you have to stay in until you've got, you know, 50% if you get a nice piece of it, you know, pretty quickly. And so this is where the art of trading comes in, right? Right. Okay, so this is a long call vertical. So that was a great question. And sometimes it's, especially when you're new to all of this, it's kind of hard to keep it all straight. And so I used to have, when I first started, a checklist for every type of trading strategy and a checklist on kind of how I managed it and as a way of keeping them straight. And that's why when I taught the Getting Started with Option series, I really recommended that you pick 1 or 2 strategies to try and develop mastery in or competence in before you know, dove into the toolbox and picked up another trading tool. Because although options can be a really powerful trading tool, if you don't know what you're doing with them, you can wreak a lot of havoc. You know, it can be expensive. You know what they say, measure twice, cut once. Yeah. And so this one we're going to compare to the long call with the flag target. Yeah, it should have been good till canceled. If it wasn't, so with Philip Morris, this is good till canceled, the 409. We want to get filled today. And now it's saying, hey, while you were talking, Barb, the price went up to 277. So if we want to just make sure that fills, we can come in and say, okay, you want 278. Tell you what, I'll give you 280. And we'll put that in our long call vertical bucket. Oh, there we go. It got filled at 267 while I was canceling and replacing the order. So now it's filled. Let me just scroll up to the top. So I did say, so there we are, we're in that one. So I did say that I wanted to talk about placing a conditional order. So we're going to go over to the dark side. Also starting with the letter P. So today's new trades are sponsored by the letter P today. But what do we see on PayPal? You know, and I guess this was a trade that we looked at a while ago. But, you know, what we're seeing now on PayPal is kind of the opposite of what we were seeing on Philip Morris, right? We are seeing, instead of a bull flag, we are seeing a bear flag, right? You know, where it's dropped, tried to rally, dropped again, rallied, dropped, and it looks like it's trying to rally again. And so if we want to be ready just in the event that it does drop, and this is like conditional orders, we can put in a conditional order that says, hey, this looks like a bear flag setting up. And if it drops on the open tomorrow and opens below today's low, so in this case, we're looking for not a close above the high of the low day. We're looking for a close below the low of the high day. And right now, this is the high day, potentially. Now, tomorrow it could go up again, in which case we'd want to change our order. So we'll look at this again on Thursday or on Wednesday, you know, which I treat as kind of a companion class to this. So how might we place that trade? Well, we could say, hey, the low for today is 70.26. So if it goes below that by 20 cents, so if it goes down to 70.06, I'd like to buy a put. And the average this stock has moved over the last 14 days in a day is about $2.30. So I am going to come over here and say, well, if I get in at 70.06 and it drops by $2.30, I'm going to make that my target. And that's 67.76, which happens to still be, you know, above this previous low that we hit here back in last September of 67.15. So we would come to our trade tab, and we don't know exactly if we come out to April and we say, okay, I don't know exactly what I'm going to pay for this, but if I buy one contract, it's currently trading at $2.24. I want to get in if it goes below. So I might end up paying $3 to $3.50, but I'm okay with that because that's still below my max risk of $5 or $500. We have 7 million shares already traded today, so that would meet that requirement. We've got thousands of contracts here, so we've got a lot of liquidity. We've got a nickel bid-ask spread, so it meets that requirement. So we are looking to buy, okay, we are looking to buy this option if and only if, and again, if I hit my sprocket and we bring this back over, if and only if PayPal goes at or below $70.06. And if this doesn't get filled tomorrow, we're going to make this good till canceled. We're going to look at the chart and see if we should adjust our entry point. Because if it goes up again tomorrow, then we'd move our entry to 20 cents below that day's candle. Does that make sense? Okay. And then if we do get in, then we're going to make our target on this to buy it back if and only, or if and when, I'm trying to be optimistic because it could go the other way. Now we can change this into an OCO order, but just so that we have on record what we want our target to be, and we want our target to be 67.76. Yeah, thanks AP 514. And so we can go in and put an exit, and we could put an exit in as a 1 ATR exit. We could put in an exit at 50% of the value of what we paid for the option. And we'll discuss that when we get in. Okay, so we've kind of looked at a bullish trade. We've looked at a potentially bearish trade. We've done a whack of trade management. And so we're going to put this in our long put, and this is a conditional order with a 1 ATR exit or target. And you know, you always want to read these notes, right? Due to potentially wide markets, the order may be substituted. You know, in other words, they're going to work hard to get you the best execution they can, but there are no guarantees. Okay. So guys, our time has come and gone. When there is a survey, and there is a survey today, but one of the things I'm often asked is, can you just review what we did today? And so we did 2 bullish trades, one on Philip Morris where we bought a call, and one where we did a long call vertical. And then on Amazon, we, you know, did the mess up, fess up, and exit because of a potential concern of being assigned. And we wanted to avoid that. We also took the money and ran with Triple M, where we were close to our target. And then we exited another position, in our trade gone wrong group on Microsoft. And lastly, we looked at Starbucks and a short put vertical on Starbucks that had hit our target. So we covered a lot of ground today. Now, there is a survey in the chat today. And my ask is that you'll take just a couple of seconds to fill it out. There are 2 questions. One was I hated it. 10 was I loved it. And then there's everything in between. Also, you have the ability to put comments in. So if you do choose to put a comment in, I promise to read every comment that goes in. And I'm just reposting the survey one last time here. Yeah, so I promise to read them all, and so will the management team. And then if you hit that like button, it just helps move things up in the trading algorithms. There's almost 100 of you that have already hit the like button, and so thank you for that. As Cameron likes to say, sounds like applause to us, so we appreciate it. But it moves this up so that more people can get exposure to this content. So you could be doing a favor for a random stranger without even leaving your house. How cool is that? And then if you haven't already subscribed, you'll want to subscribe to the channel. Last but not least, don't forget to follow Cameron and I in the land of X, Barb Armstrong CS and Cameron May CS. And with that, my friends, have a really awesome rest of your day. I will look forward to seeing you soon. Up next is the fabulous Mr. James Boyd. You'll want to stay tuned for that. Take care, everyone. Bye for now.